So, I want you to picture something. Think back to 2022.
Oh, man. Yeah.
Right. Thousands of homeowners literally watching as these unprecedented storm surges just swallowed their entire neighborhoods.
Just devastating.
It really was. And the craziest part is these were people who did everything right. I mean, they paid their insurance premiums on time every single month for like a decade or more.
Yeah.
But then the water finally recedes and they call their insurance companies to, start rebuilding their lives. And they get hit with this completely devastating shock.
Their insurers didn't owe them a dime.
Not a single dime. And so today, for this deep dive, we are looking at the actual mechanism that makes a scenario like that legally possible.
Right, because it sounds illegal when you first hear it.
It totally does. We are diving into probably the single most ignored PDF sitting in your inbox right now, the insurance policy.
Absolutely, the most ignored. Nobody reads it.
No one. So our mission today is to tear down this huge misconception that this document is just like a polite confirmation email or a receipt for your premium.
Yeah, it's so much more than that.
Exactly. We're going to explore the strict legal framework that essentially dictates your financial survival after a disaster.
Right.
We'll get into how actuaries and underwriters mathematically construct this document to isolate risk and why the language hidden in the back pages completely overrides whatever assumptions you might have about being covered.
Covered is such a dangerous word, honestly. And I think the foundation we really need to establish here right up front is the absolute difference between the concept of insurance and the literal insurance policy.
Okay, break that down for us, because people definitely use those interchangeably.
Oh, all the time. And that is exactly where the financial danger begins.
Yeah.
So insurance, just as a concept, is the abstract risk transfer mechanism.
Right.
But the policy, that PDF you mentioned, is the written, highly regulated legal instruction manual. It's a contract that binds two parties to a very specific set of parameters.
Well, the sources actually had this brilliant analogy for this that I think completely reframes the relationship.
The real estate one.
Yeah, the property ownership one. So think about buying a house, right? The physical house is your shelter. It keeps the rain and the elements out.
Sure.
But you can't just walk into a courtroom and declare, hey, this shelter protects me, therefore it belongs to me.
Right, they left you out of court.
Exactly. You need the deed. The deed is the legal architecture proving your rights to that physical protection. So in this analogy, the concept of risk transfer is the house, but the actual insurance policy...
This is the deed.
Yes.
It's the deed.
That's a perfect way to look at it, because the policy is the proof of the promise. I mean, it strictly outlines the insurer's obligations to you, but also, and people forget this, your legal responsibilities to them.
Right, it's a two-way street. It is. It defines the exact environments where a claim trigger is actually activated. And it sets the absolute financial ceiling of that protection.
Which brings us to the harsh reality of claims. Because understanding those legal boundaries only really hits home when a policyholder's assumptions just completely collide with an actual claims adjuster.
Yeah, that's when things get real. Fast.
Very fast. And the materials provided this highly illustrative scenario that I want to walk through. It's about a homeowner named Sarah.
Yes. Sarah's situation is basically a masterclass in how these contracts function in the wild.
It really is. So let's set the stage. Sarah buys a standard homeowner's policy, and she looks at her declarations page.
Which is just that single summary sheet at the very front of the document, right?
Exactly, the one page people actually look at.
Yeah.
So she sees some substantial numbers there. She has $400,000 in dwelling coverage, $40,000 for other structures, and a standard, say, $1,000 deductible.
Sounds great on paper.
Right. So a few months into the policy, this severe windstorm rips through her county and just tears the shingles right off her roof.
Okay.
So she files a claim, and because wind is an included peril in her contract, the insurer's adjusters come out, they assess the damage, apply her deductible, and they cut her a check for the repairs.
Boom. The system worked. And, psychologically, that initial successful claim is super powerful.
Oh, I bet.
Yeah, it completely reinforces Sarah's assumption that she has this comprehensive safety net. She thinks, well, I had damage, they paid, I am fully protected.
But here is where it gets really interesting. Because fast forward 6 months later.
Uh-oh.
Yeah. The snowpack melts aggressively during some heady spring rains, and the river that's like a mile from Sarah's house crests its banks.
Not good.
Not good at all. Rising water completely inundates her basement, just destroying the foundation and everything inside.
Right.
So she calls the insurer, again, operating on this perfectly logical assumption. She has homeowner's insurance. They paid for the roof, so obviously they'll pay for the basement.
And that phone call is what absolutely shatters that assumption. Because the flood claim is denied immediately.
Just flat out denied.
Flat out. Because claims adjusters, they don't just pull up your file to see if you have an active account and then send a check.
Right.
They are essentially contract interpreters. So when Sarah's second claim is filed, that adjuster opens that 50-page PDF and uses it as this rigid algorithmic tool.
An algorithm, wow.
Yeah, they're looking for 3 very specific data points. First, is the triggering event covered? Second, what is the maximum financial exposure? And third, critically, does an exclusion apply to this specific peril?
And that word right there, exclusion, is the entire reason Sarah is left paying for a new foundation out of pocket.
Exactly. Because she relied entirely on that declarations page, which, let's be honest, only advertises the best case scenario.
It's the marketing page, basically.
Totally. If she had read the actual contract, the actual deed in your analogy, she would have found an entire section explicitly detailing exclusions. And standard homeowners policies contain ironclad, undeniable exclusions for flood damage caused by rising external water.
So the adjuster's hands are basically tied by the text.
Exactly, tied.
Okay, let's unpack this for a second, because I think a lot of people get tripped up here. If an insuring agreement is the section where the insurance company explicitly promises to indemnify you for losses,
Right.
how do they legally just sidestep that promise with an exclusion? I mean, an insuring agreement sounds like a blank check. It says, we promise to insure your property.
Yeah, it does sound like that.
Right.
Yeah.
So how can a court uphold a contract that gives you this massive promise on page 1 and then just takes it away on page 30?
Well, because the insuring agreement is never a blank check. It's just the starting point of the legal architecture.
Yeah.
The scope of that very first promise is immediately bounded and shaped by the rest of the document. And the sources actually use this incredibly effective memory acronym that CPCU candidates use to visualize the structure.
Oh, right. CLEC.
Yes, CLEC.
Let's break that down, because I feel like understanding this framework fundamentally changes how you read any legal agreement, not just insurance.
Absolutely. So the C stands for coverage. This originates right from that initial insuring agreement. It broadly defines the property or the person or the liability that is the subject of the protection.
Okay, so in Sarah's situation, the coverage was applied to the physical dwelling.
Exactly.
Yeah.
Next is the L, which represents limits.
Right. The money.
The money.
Yeah.
Limits establish the absolute maximum financial exposure the insurer is willing to take on for that specific coverage. It caps the promise mathematically.
So if Sarah's dwelling limit is $400,000, the insurer's liability just ceases at that exact number.
It ceases, period. Even if the actual rebuild cost is $500,000 because of a sudden spike in lumber prices or inflation.
Wow. Okay, so we have the broad coverage, we have the financial limits, and then we hit the E.
Exclusions.
Exclusions.
This is the mechanism that literally carves away at that broad promise. Exclusions identify the exact perils, situations, or types of damage the policy will absolutely ignore.
So the insurer is effectively saying, we cover the dwelling up to the limit, except in the event of nuclear hazard, earth movement, or, as Sarah learned,
Rising floodwaters, exactly.
you know, I was reading through the source materials, and an analogy came to mind that feels much more accurate than how people usually describe this.
Oh, let's hear it.
Okay, so an insurance policy is essentially a physical security fence around a property.
I like this already.
Right. The insuring agreement simply establishes the perimeter of the fence.
Okay.
The limits dictate how high that fence is built, but the exclusions are these specific, intentionally unguarded gates along that perimeter.
Yes.
The insurer is telling you exactly which gates they are going to leave wide open, and if a threat walks through an unguarded gate, they are not liable.
That perfectly illustrates the mechanics of risk isolation. They are mapping out the precise shape of the risk they're willing to absorb.
It's so visual.
It is. And that actually brings us to the final C in the CLEC framework.
Right. Conditions.
Conditions, which, sticking with your analogy, represents your obligation to actually maintain that security fence.
And I found this condition section so fascinating because it totally shatters the idea that having insurance is a passive experience. Like, you actually have ongoing legal duties to the insurer.
Oh, absolutely. A contract requires performance from both sides. So conditions dictate the rules of engagement. For instance, after a loss, you have a strict legal duty to mitigate further damage.
Make that real for us. What does that mean for a homeowner?
Well, let's say your roof is damaged in a storm, right?
Yeah.
You cannot simply leave it exposed to the elements for 6 months, allow all the internal framing to rot out, and then file a claim for the rot.
Because you didn't tarp it.
Exactly. The insurer will pull out the policy, point to the conditions section, note your failure to protect the property, and legally deny the secondary damage.
That makes total sense, but it begs the question, if the CLEC framework dictates all these rules of engagement, who actually designs the fence in the first place?
Ah, the architects.
Right, because the exclusions and limits aren't just, arbitrary legal hurdles designed to frustrate people, although it feels like it.
It definitely feels like it sometimes.
Someone had to mathematically decide that wind is an acceptable risk for a standard policy, but a river cresting its banks requires an absolute exclusion.
Yeah, and that transitions us beautifully into the quantitative side of the industry. Underwriting and risk modeling.
Underwriters.
Underwriters, they are the true financial architects of the insurance policy. They don't just sit around writing legal jargon. They are translating complex actuarial science into enforceable contract language.
So I really want to dig into the why behind that math. Why is Sarah's wind damage an acceptable risk while the flood damage requires this ironclad exclusion?
Well, it really comes down to this core concept. The difference between independent risk and correlated risk.
Okay, walk us through that.
So underwriting relies heavily on the law of large numbers. If an insurer writes 10,000 policies across an entire state, they know a certain percentage of those homes will experience a kitchen fire or a localized windstorm.
Sure.
Those events are independent. One house catching fire on the east side of town does not mean a house 3 miles away is going to catch fire. The risk is distributed, which is what keeps the whole system solvent.
But a flood doesn't just hit one house.
Exactly the opposite. A flood is a highly correlated catastrophic risk. When a river crests or a storm surge hits the coast, it doesn't just damage one home. It simultaneously destroys 5,000 homes in the exact same zip code.
Oh, wow, yeah.
The financial magnitude of that concentrated event would instantly bankrupt a standard insurance pool.
It would wipe them out.
Completely wipe them out. So underwriters mathematically model that correlation and realize, hey, we cannot absorb this within a standard premium structure.
So they have to exclude it.
Therefore, they must mandate an exclusion in the policy language, which forces homeowners to seek that specific coverage through specialized risk pools, like the National Flood Insurance Program.
So every single limitation, every condition, every exclusion in that massive PDF is actually the physical manifestation of an underwriter's catastrophic risk model.
It is the pure reflection of the underwriting intent.
Yeah.
And this is also why your pricing is inextricably linked to the contract language.
Because more coverage equals more risk.
Exactly. Premiums are calculated based strictly on the statistical likelihood of a payout within the bounds of that specific CLEC framework.
Right.
If you call your broker and request the removal of an exclusion or demand higher limits,
The underwriter's exposure increases?
right, the mathematical models adjust instantly, and your premium rises accordingly to fund that broader risk transfer.
Hearing all this, I imagine state regulators have a pretty significant role here.
Yeah.
Because an underwriter could theoretically write a policy that excludes claims filed on a Tuesday just to lower their exposure.
Right, technically they could write that.
But they clearly don't.
No, they don't. And that's because the industry is heavily regulated at the state level precisely to prevent predatory exclusions like your Tuesday example.
Okay.
State departments of insurance actually have to review and approve the policy forms used by these insurers. They analyze the contract language to make sure it complies with statutory law, doesn't violate public policy, and, provides a genuine baseline of fair protection.
So it's not just the Wild West.
No, the underwriting intent has to align with regulatory standards before it ever becomes a legally binding document.
And because these documents are scrutinized by regulators and drafted by actuaries and argued over in courts every single day, they are the subject of intense professional study.
Oh yeah, people spend their whole careers on this.
Which blew my mind. I was looking at the curriculum for the Chartered Property Casualty Underwriter designation.
The CPCU?
Right, the CPCU. Which is basically the gold standard credential in this space. And courses like CPCU 530, which focuses on U.S. law and contract law, they spend hundreds of hours dissecting the legal nuances of these policies.
It's intense.
Yeah.
And the CPCU materials are really illuminating because they actively test candidates on the most common misconceptions held by the public and honestly even by junior professionals.
They set traps.
They intentionally set conceptual traps on the exam.
Well, one of the distinctions that caught me off guard in the CPCU 530 material was this intense legal separation between coverage and policy. Because in everyday conversation, people say, oh, I have full coverage.
Right.
But legally, that phrase is essentially meaningless.
The exam actually penalizes candidates who conflate the two. As we saw with the CLEC framework, coverage is merely one component of the overall architecture.
Just the C.
Just the C. You cannot possess coverage without the binding constraints of the limits, exclusions, and conditions. Relying on the existence of coverage without understanding the entire policy is exactly how scenarios like Sarah's flooded basement occur.
Wow. Okay, there is another major legal trap in the CPCU materials that I actually want to push back on for a second.
Okay, let's hear it.
Because it directly contradicts how business is done in the real world every day. It's the distinction between an insurance policy and a certificate of insurance.
Ah, yes. The infamous COI.
Yes. So look, I lease commercial space, right? And every year, my landlord demands a certificate of insurance.
Standard practice.
So I call my broker. They generate a document with my liability limits. It's got the insurer's official logo on it, a signature. I hand it to the landlord, and the legal requirement of my lease is completely satisfied.
Yep.
How is that document not legally binding?
Okay, so this is perhaps the most dangerous misconception in both commercial and personal liability.
Really?
A certificate of insurance is just an informational snapshot. It merely provides third-party evidence that a specific insurance policy existed at the exact moment the certificate was generated.
But wait, it lists my $1 million liability limit right there on the page.
Sure, it lists a number, but it does not contain the contract. The certificate does not include your exclusions. It does not list your conditions.
Oh.
Crucially, a certificate of insurance cannot alter, extend, or forward any legal rights that are not explicitly written in the underlying multi-page policy.
So what happens if there's a lawsuit?
When a catastrophic liability claim is filed, the opposing attorneys and the claims adjusters, they do not litigate based on that certificate.
They demand the actual policy.
Exactly. So if your certificate says you have $1 million in liability, but the actual 50-page policy contains a buried exclusion for the exact type of negligence you're being sued for.
The certificate is completely worthless in court.
Completely worthless. The exclusion in the underlying policy will govern the outcome every single time. The legal relationship and the obligation to indemnify are created exclusively by the policy itself.
So the certificate is literally just a receipt.
It's a receipt. The policy is the law.
Which brings up a fascinating secondary issue here. We are talking about these policies as these ironclad, mathematically perfect legal documents, right?
Yeah, that's how insurers view them.
But they are written in human language. And human language is inherently flawed and messy.
Very true.
So what happens when a team of underwriters and lawyers draft a 50-page document, a catastrophic loss actually occurs, and the entire multi-million-dollar payout hinges on a single phrase that turns out to be ambiguous?
Well, contract ambiguity is a central focus of insurance litigation. It happens all the time. When a dispute arises over the interpretation of a word or a clause, the courts actually rely on a legal doctrine known as contra preferentum.
Contra preferentum, which means against the offerer.
Precisely. The doctrine basically states that any ambiguity in a contract must be interpreted strictly against the party that drafted it.
Oh, wow.
Because insurance policies are what's called contracts of adhesion.
Meaning what exactly?
Meaning the insurer drafts the entire document and offers it to you on a take-it-or-leave-it basis without any real negotiation. Because of that power dynamic, the courts will generally favor the policyholder's interpretation, provided that interpretation is reasonable.
That is a massive legal lever for the consumer.
It really is.
Because the insurer has the actuarial teams and the massive legal departments to draft all the rules. But if they leave a grammatical loophole, the consumer actually gets the benefit of the doubt.
It forces insurers to be hyper-precise with their exclusions. If they want to deny a specific peril, they must articulate that denial with absolute clarity, or they risk paying the claim based on the ambiguity.
That is so interesting. Okay, so what does this all mean for you listening right now? We started by looking at that easily ignored PDF in your inbox, and we discovered it is actually the central engine of your financial security.
Without a doubt.
We explored the CLEC framework, coverage, limits, exclusions, and conditions, which, as we said, acts as the security fence around your assets. We examined how underwriters use correlated risk models to decide exactly which gates to leave open, which unfortunately leaves people like Sarah completely exposed to floodwaters.
Yeah, Sarah learned the hard way.
She really did. And we learned that the actual policy is the only document that holds up in court, completely superseding any summary or certificate you might have been handed.
When you really zoom out, you realize that the insurance policy is the universal language of risk.
Yeah.
When a disaster strikes, the homeowner, the claims adjuster, the underwriter, the opposing counsel, and the judge are all forced to speak that exact same language to determine the financial fallout.
It is the ultimate legal blueprint.
Exactly.
And that leaves me with a final thought for you to ponder today, building on that doctrine of contra proferentum we just talked about.
Okay.
We know the law is technically supposed to favor the consumer when a contract is ambiguous, right?
Right, that's the theory.
But think about the reality of a massive catastrophe. If your home is literally wiped off the map, you are living in a cramped hotel room, and you are trying to fight an interpretation of a single comma in your policy against an insurance company with a billion-dollar legal war chest.
Yeah.
Does that legal doctrine actually level the playing field? Or is the sheer endurance required to fight an ambiguous clause just another unwritten exclusion?
Oh, that's a chilling thought.
It is. Something to think about the next time you open that adulting folder on your desktop. Seriously, go read the exclusions on your own policies today. You might be very surprised by where your fence ends.
Thanks for having me on.
Until next time on The Deep Dive.